Good afternoon again to everyone, and welcome to the 5th edition of the Eurosif Sustainable Finance Update. So we're delighted to see a high level of interest in these sessions. We've waited until October to recommence the monthly updates, since August was relatively quiet on account of the summer break, and September has not seen too many what we could describe as public developments. That said, as we shall see, as we'll discuss, plenty has been going on behind the scenes in relation to the EU taxonomy and SFDR in particular. So, we're happy to share our latest information on that. And so if we just quickly take a look at the agenda for, if we quickly take a look at our agenda for this afternoon, we'll provide you with updates on, firstly, a special report by the European Court of Auditors, or the ECA, on the implementation of the Sustainable Finance Agenda. We'll follow that with an update on the state of play of the EU taxonomy, more specifically the Climate Delegated Act and the so-called Complementary Delegated Act that will clarify the treatment of natural gas and nuclear energy under the taxonomy. We'll also just bring you through the delay and future timing of the regulatory technical standards under the SFDR. And finally, we'll take a brief look at the sustainability related provisions proposed by the Solvency II framework and the work of EFRAG thus far in developing sustainability reporting standards under the CSRD. So throughout the update, of course, we would welcome any questions that you might have. We'd ask that you use the Q&A function as opposed to the chat, and we'll do our best to get back to you either, live or with a written comment. And there should also be time at the end for a Q&A. So, if we need to proceed with the updates and leave your question unanswered due to time constraints, we can probably, revert back at the end of the session. So with that, let's sort of launch into some of the meat of the update. So, to set the scene, in late September, the European Court of Auditors published a special report on the implementation of the 2018 Sustainable Finance Action Plan. The report also looked at whether the EU funded sustainable projects in a consistent and systematic manner. When it assessed the progress toward realizing the 2018 action plan, the ECA noted that the majority of measures that had been envisaged by the plan were focused on improving transparency in the market, such as through instruments like the taxonomy and the SFDR. So the ECA acknowledges that transparency is fundamental, but it concludes in its report that transparency alone is inadequate to reorient capital to sustainable projects. Now, they recognize that this is partly due to the fact sustainable projects often entail higher risks and lower returns on investment than more conventional projects. To illustrate that point, they cite climate change adaptation projects in particular, which tend to be costly and offer relatively little in terms of returns that would incentivize private investment. In the ECA's view, accordingly, transparency alone will not alter just the fundamental economics of some sustainable projects. Conventional projects and investments will remain more attractive to investors from a financial standpoint unless negative externalities are somehow priced in or reflected by the market. And of course, the ECA recalls in its report that pricing negative externalities was identified as a crucial complement to transparency by the high-level expert group on sustainable finance, which many of you probably remember advised the Commission while it was conceiving the 2018 action plan. Then, in terms of implementation of the action plan, the ECA highlights that major pieces of legislation needed to operationalize sustainable finance, namely the taxonomy, SFDR, have been experiencing very major delays and setbacks. And actually that foreshadows what we'll discuss a bit later in this session. But effectively, this has rendered it more challenging for sustainable projects to attract private investment. Simply, the framework is not in place. And so, private investors aren't really equipped at present to contribute to climate change mitigation, climate change adaptation. Then when it comes to the allocation of EU funding to sustainable projects, the ECA notes that the European Investment Bank has been the most rigorous and systematic in applying sustainability criteria to its investments. And it carefully assesses the environmental and social aspects of an investment and will offer funding on more favorable terms to projects that satisfy its criteria. Unfortunately, on the other hand, the ECA finds that the European Commission, when it has come to dispersing funds under the EU budget, has not always consistently applied a clear set of sustainability criteria when it comes to project funding. And so based on these findings, the ECA recommends that the European Commission should, complete The European Commission should complete measures of the 2018 action plan and clarify how entities subject to the taxonomy SFDR should comply. It should also, contribute toward pricing negative externalities so as to, affect risk return calculations on the part of investors. Also, the Commission should systematically report on the climate and environment related results of EU funded projects, apply the taxonomy criteria to the EU budget, and also generate a pipeline of sustainable projects. So, moving on to the next section on the taxonomy, which was nicely foreshadowed by the ECA report. We wanted to provide some insight into the current state of play of the EU taxonomy and the progress of, pardon me, these slides are not cooperating, but just progress of the Climate Delegated Act in particular. So, as many of you will be aware, the Climate Delegated Act was adopted by the European Commission in June with a scrutiny period of 4 months. And in that time, either the European Parliament or the Council could object to the contents of the DA or the Delegated Act. And they could also request an extension of 2 months to the scrutiny period. And it is the latter scenario that has occurred. So, of course, in mid-September, the Council voted by a simple majority to extend the scrutiny period by 2 months. And that, of course, means that the scrutiny period will now continue or last until the 7th of December of this year. So we understand that both France and Germany voted in favor of the extension to the scrutiny period and pressured several smaller member states to do likewise. According to intelligence that we've received, several of the smaller member states that voted in favor of extension were actually quite reluctant to do so. But of course, it's widely speculated at this point, and I need to be clear, that it is speculation. That motivation for prolonging scrutiny of the Climate Delegated Act is to apply pressure on the European Commission as it finalizes the so-called complementary Delegated Act that will clarify the treatment of natural gas and nuclear energy. So in the meanwhile, as the Council has voted for an extension of the scrutiny period, in the European Parliament, there were 3 motions tabled over the course of September to object to the Climate Delegated Acts in the Econ Committee. Each of them were rejected at committee level at the end of September, 27th of September, if you want to be precise. Following on from this, only yesterday, the plenary of the European Parliament endorsed the Climate Delegated Act by a significant majority in Strasbourg. And what effectively this signals is that there is no real prospect of further objections being raised in the European Parliament, which effectively leaves only the Council holding out. And of course, as mentioned, it's speculated they're holding out because of the complementary Delegated Act. Now, the Commission's original intention was to publish the complementary Delegated Act on the 7th or 8th of October, which uncoincidentally is the date on which the scrutiny period for the Climate Delegated Act was originally due to end. Now, the Commission had always planned to sequence the 2 delegated acts. And so now, given the extension by the Council, we have heard that the Commission plans to publish the complementary Delegated Act in Q1 2022. And, presumably the logic there is to avoid the 2 being entangled, or the Climate Delegated Act being held hostage over the contents of the complementary Delegated Act. When it comes to those contents, we understand that at this point, the complementary Delegated Act will include natural gas and nuclear energy in some form. And so to some extent, at least, they will be regarded as sustainable. Now, we don't really have any detail, but apparently it's now been the case for some time that natural gas and nuclear energy will be included, at the insistence of some very influential member states, France, Germany, that have effectively come to an agreement that they should both at least be recognized as sustainable for a certain length of time. So I'll just check at this point, before continuing, on some of the questions. So one from Pietro. And I'll just, as a reminder, I see that a few are posting in the chat. So if you do have questions, please use the Q&A function. But just before moving on, Pietro, I'll quickly answer your question. So when it comes to increase the bankability of sustainable investments, which I included in the slides, what the Commission is effectively means is something should be done. The ECA is not very specific, but something should be done just to make sustainable projects more commercially or economically attractive. And so, at present, often sustainable projects are quite costly. They entail quite high risk and don't really offer very high returns. And so when it comes to increasing their bankability, the ECA just recommends that the Commission should do something to render them more attractive to private investors. So maybe de-risk them somehow by contributing public finance. So I hope that answers your question. You're very welcome. And then just quickly before moving on, when it comes to the difference between the Climate Delegated Act and the Complementary Delegated Act, just very quickly, the Climate Delegated Act sets out the technical screening criteria for the first 2 environmental objectives in the taxonomy. So that is climate change mitigation and climate change adaptation. And then the complementary delegated acts is actually sort of, as the name suggests, a kind of additional add-on to the taxonomy that the Commission committed to developing because of the significance of natural gas and nuclear energy in the energy mix of various member states. And so it's obviously for that reason quite a source of controversy. But I hope that clarifies your question. But let me know if not. Okay, but with that all said, we can move on now to the next item, if of course the slides cooperate. Give me a moment. Here we are. Yeah. So we also wanted to give you an update on the status of the SFDR technical standards for taxonomy related product disclosures, the final adoption of which is still pending. And I'm sure as many of you that have been following this are painfully aware, the technical standards have been subject to multiple delays, which has severely hampered SFDR implementation and necessitated a deferral of final application of the level 2 requirements by 6 months to the 1st of July 2022. But of course, as all of the RTS under SFDR will be bundled into a single delegated act by the European Commission, delay to these taxonomy related product disclosure RTS sets back SFDR implementation as a whole. The cause of the delay when it comes to taxonomy related product disclosure technical standards has been a disagreement between the European supervisory authorities, so that's ESMA, EIOPA and the EBA, over the substance of taxonomy related product disclosures. And more specifically, the ESAs who jointly developed these technical standards and so jointly have to sign off on them before they can be published, disagree over whether exposures to sovereign bonds should be reflected in taxonomy related product disclosures. ESMA, with kind of more of an investor protection perspective, is adamant that exposure to sovereign bonds should be reflected. They feel excluding them would mislead investors. EIOPA, on the other hand, believes sovereign bonds should be excluded from the calculation of taxonomy alignment at product level because of the challenges associated with assessing their taxonomy alignment. It's known to be quite, well, notoriously difficult, if not impossible, to really determine whether a sovereign issuer is taxonomy aligned. Nevertheless, in spite of this delay, we have heard that on Tuesday this week, the final RTS was submitted to the boards of both EIOPA and the EBA for approval by written procedure. Any member of the Board of Supervisors of either EIOPA or the EBA can raise objections until next Tuesday, or the 12th of October. And in the absence of any further comments or objections, the RTS will be considered approved by both EIOPA and the EBA. At that point, they'll pass to ESMA for final validation and are expected to be approved. We then expect them to be published soon thereafter, possibly late next week or at the latest, early the following week. We understand, of course, that the Commission will then consolidate the RTS developed by the ESAs into a single delegated act that will be adopted in February of 2022. So I, of course, have to stress that these are indicative timings, and we can't guarantee that this is actually what's going to transpire. However, this is what we have heard. So we hope that offers a little bit of clarity, you know, as to the timing of the standards. Now, unfortunately, you know, that doesn't mitigate some of the confusion that has emerged over the application dates of various provisions of SFDR. And we at Eurosif are aware that there's multiple different stakeholders in Brussels that are trying to get clarification. So I mean, with that, I will actually just see no further questions. But yeah, I mean, with that, I think, you know, we can move on to our next item. And, you know, for that, I will pass you over to my colleague, Federica, for a quick update. And I'll also just get the right slide in place. So thank you.
So thank you and good afternoon to everybody. I will briefly update you on the Solvency II developments. So on September 22, the European Commission put forward a comprehensive review of the Solvency II directive, which regulates the insurance and reinsurance industry in Europe. The review consists of two legal elements. The first one is the legislative proposal with the amendments to the Solvency II directive. And the second item is a communication of the European Commission with explanations and clarifications. So broadly speaking, the objectives of the Solvency II review now are improving the financial strengths of insurers and reinsurers through an improved capacity of manage risks and a better consumer protection with more information available to policyholders. So as stated by the Commission, the aim of this review is to ensure that insurers and reinsurers keep on investing, so supporting the political priorities of the European Union, among which what it's interesting and relevant to us, implementing the EU Green Deal. So why this review is relevant for sustainable finance? Well, mainly for two elements. The first one relates to climate risk management. So insurers and reinsurers will be required to conduct long-term climate scenario analysis. The second element is related to the possible introduction of a dedicated prudential treatment of the exposure related to assets or activities associated with environmental or social objectives, the so-called green supporting factor or brown penalizing factor, but we will elaborate on these in a few minutes. So after an assessment that will be conducted by EIOPA, and the report is expected by the end of June 2023. So on the first point, insurers and reinsurers will be required to conduct long-term climate scenario analysis, in particular, at least on two scenarios, below and equal or higher than 2 degrees. Insurers classified as low risk profile undertakings are exempted from scenario analysis in the proposal. And as stated by the Commission in the communication, at the later stage, the Commission might consider extending this requirement to other environmental risks, not only the climate ones. On the second point, which is the most contentious one, the Commission gives EIOPA a mandate to explore a dedicated prudential treatment of the exposure on the basis of sustainability criteria. In particular, EIOPA is required to assess the potential effects of a dedicated prudential treatment of the exposure related to green and social sustainable assets, the so-called green supporting factor, and a dedicated prudential treatment of the exposure related to assets that significantly harm the environmental and social objective, the so-called brown penalizing factor. So just to clarify, brown penalizing factor consists in an increased capital requirements for investment which are environmentally or socially harmful to counterbalance the increased risk. Vice versa, a green supporting factor consists in a reduced capital requirements for green investments to take into consideration the benefits in terms of climate risk mitigation. So there are also two other elements EIOPA is also required to review the scope and the calibration of the non-life standard parameters with respect to natural catastrophe risks. And finally, the Commission stated that to narrow the climate protection gap, a climate resilience dialogue will be set up by 2022, so next year, bringing together various actors such as insurers, reinsurers, public authorities, and other relevant stakeholders. So let me just conclude providing a little bit of background to understand the importance and the relevance of these developments. So first of all, in the Sustainable Finance Strategy published in July, the Commission announced both the upcoming amendments to the Solvency II directive regarding the climate change scenario analysis and the mandate to EIOPA regarding the green supporting or brown penalizing factor, and the amendments possible to the prudential requirements for banks and insurers regarding green assets were envisaged also back in 2018 in the Action Plan on Financing Sustainable Growth. The introduction and choice between green supporting and brown penalizing factor is a very contentious issue. Indeed, there was a strong and negative reaction of the insurance industry to the proposal. And we want to highlight and underline the fact that the advice of EIOPA is due by the end of June 2023. So probably the issue will be analyzed and taken into consideration by the next European Commission. So this is not something that is supposed to happen quite soon. Which are the next steps? The European Parliament and the Council will now discuss the Commission proposal as the legislative procedure requires. So we will wait for the next step of the process. And so with that, I will give you the floor to Hugo for the next item of our agenda today.
Thanks very much, Federica. So with that, we will just pass on to the final item on our agenda today. And again, there we are. So we just wanted to, provide not a particularly detailed update, but sort of as an FYI, just to inform you about some of the work that has been going on at EFRAG under the CSRD proposal. So of course, as many of you will be aware, EFRAG has been mandated by the European Commission to start developing sustainability reporting standards, which will specify, detailed reporting requirements under the CSRD. So of course, just to provide context, the CSRD proposal was tabled in April of this year, and it's currently going through the legislative process. So at present, at Council and at the European Parliament, the relevant bodies are working on the positions of those two institutions, which will then be subject to negotiation through trilogues. But in the meantime, EFRAG has been tasked to actually already start developing the sustainability reporting standards that will be put into effect by CSRD. And so for that reason, it's something which is actually quite important to follow from our point of view, because it does give some indication as to the thinking of EFRAG at this point, and ultimately what then might be included in the final sustainability reporting standards that they provide for or to the Commission. So effectively, just having provided the context, recently EFRAG published what was a working paper on a climate standard prototype. So of course that refers to climate related sustainability disclosures that companies subject to CSRD, could potentially be subject to when that piece of legislation enters into force. And effectively, according to this climate standard prototype, EFRAG at this juncture envisages disclosures by companies in three broad areas. One is in relation to their strategy. So of course, how exactly does their business strategy take account of climate impacts, risks, and opportunities? The second is, implementation of various policies and targets that, might be put in place at company level to mitigate the climate impact or, improve their performance from a climate or environment standpoint. That of course includes any net zero policies or targets that are announced by the company. And then the third area is performance measurement. So of course, in a sense that would capture the actual impact of the company's operations, its climate performance, at any given point, such as things like its energy consumption and mix, its emissions, its carbon intensity, etc. So we just wanted to draw everyone's attention to that this climate standard prototype has been published, but it is, of course, at this point only an internal document. It forms the basis of EFRAG's current work and is subject to internal discussion. And they, of course, have only really published it just to keep the public apprised of the work that they're carrying out at present. But we, at least at Eurosif, will be following closely the work of EFRAG just so that we can, keep on top of the discussions and better understand, what exactly the final sustainability reporting standards may contain. But I think, with that, we are, effectively at the end of our sustainable finance updates. And so there are, a few, questions I see, and so we'll do our best to answer them before, letting everyone continue with their afternoon. But we have, someone asking here, could you please clarify what is the scope of EU taxonomy reporting that is required on January 1st, 2022? Do investors need to report their taxonomy alignment? So that is, of course, a very pertinent question. Oh, the question seems to be gone, but no worries. So, effectively, if investors, if by investor you mean a financial institution, pursuant to the Article 8 Delegated Act that was adopted over the summer, of course, financial institutions will not actually have to disclose their level of taxonomy alignment until 2024. So as of 1st January 2022, all that will have to be disclosed is taxonomy eligibility at entity level for a financial institution. And so as of yet, it's not entirely sure what, is even meant by the term taxonomy eligibility. The Commission at present is working on an FAQ document to clarify that very point. Where the complication arises is, of course, at product level. As of 1st January 2022, there is still a strong possibility that, taxonomy alignment of your financial products will have to be disclosed, despite the fact that underlying companies that are represented in your portfolio will not have to disclose their taxonomy alignment until 2023. So there is quite a few misalignments in terms of application dates between the taxonomy and the SFDR, which cause significant complications. As I mentioned a bit earlier, there's a lot of different stakeholders that have mobilized to try and get some of these, application dates deferred or somewhat better aligned. One of the issues that we see there from a legal perspective is a lot of these application dates are actually stipulated in the level 1 text of the primary legislation. And so the Commission is not legally able to disapply them without reopening those legislative texts and revising those provisions, those specific application dates. So this is the sort of predicament we find ourselves in, which is obviously not a very enviable one, but I hope at least that answers your question and doesn't create more confusion. But there we go. And let me see, good afternoon. Any progress regarding independent verifiers? I can't say, I have heard anything or we have heard anything specific about independent verifiers or second party opinion. I have heard concern be expressed over how impartial second party independent verifiers are. And so that is likely going to, you're probably already aware of that, but that is likely going to be an issue in CSRD, that some provision to ensure the independence of verifiers providing a second party opinion will have to be proven or ascertained somehow. And then Pietro, on the eco label, I'm afraid I'll have to disappoint you. I don't have any further information. I don't know, does do one of my colleagues, but I'm sorry to disappoint you on that, but we'll look into it. We'll make sure to give it some attention on our next update. So I think, if okay, so we have one final question. Well, thank you, first of all, to Robert. You're very welcome. So the difference between taxonomy reporting at financial institution level and at product level. So, effectively, as an entity, financial institutions subject to the taxonomy will have to disclose their level of taxonomy alignment, and how a financial institution will calculate that is by looking at their exposures. And effectively, they're supposed to produce a green asset ratio, it's called, whereby they will specify or demonstrate what proportion of the assets in which they invest are associated with, activities aligned with the taxonomy. And of course, that necessitates that you look at the companies underlying those assets. The problem in terms of timing is the Article 8 Delegated Act that was adopted earlier this year has delayed the requirement to report on taxonomy alignment at entity level for both non-financial companies and financial companies. At product level, there's still a need to report on taxonomy alignment of products, financial products. So if you take, a fund portfolio, say, you'd have to specify what proportion of the assets represented in that portfolio, are associated with activities aligned with the taxonomy. Those product level disclosures will still come into effect in 2022. And so the problem is that they're very challenging to make when the underlying companies that are represented in product portfolios are not required to disclose their taxonomy alignment. So what that will require is engagement on the part of a financial institution in order to actually gather that information from its investee companies. So I hope that clarifies your question. So there we are, I think. And if not, please don't hesitate to send us an email. You can reach me at hugo.gallagher@eurosif.org, or of course federica.casarsa@eurosif.org. But I think with that we can close the session. So thank you to everyone for joining. And please, of course, if you're interested in following us more closely, we're on Twitter, we're on LinkedIn, and you can also subscribe to our monthly newsletter. So with that, I'll wish everyone, a very good afternoon, and thank you for tuning in today. And until the next time. So ciao all.
Bye and thank you.